Brent, really good to see you as always. Today, we are talking through the three different tax buckets. Strategic planning utilizes a combination of all three accounts, which can reduce your taxes in retirement. So the first bucket is known as your tax deferred bucket.
Yes, and so this is kind of the king of the retirement savings funds. So what happens here is you contribute to these accounts with pre-tax dollars. So you actually get a benefit today. So that money is going to continue to grow over the years that you're contributing to it, and then you're going to be tax deferred. So you don't have to worry about taxes until you pull on those funds in retirement. And so it
Right.
allows for a bigger balance, but then you also have to consider that one day you will have to pay taxes on those dollars.
That's why those 401ks are known as retirement tax time bombs. Good point. So the
Correct.
next bucket we have are the taxable accounts.
Yes, so taxable accounts are great because the tax-free and then the pre-tax accounts usually have contribution limits. And so if you have some extra cash on top of those accounts to put in, this is a great place to do it. And so you're going to put in those funds after tax, so no benefit today, but you'll never pay taxes on that principal. But you could do capital gains tax on the earnings on those accounts. So that's something to keep in mind.
Right. And then the last bucket is known as your tax-free accounts. Got to say, I like the sound of free.
Correct. So these are one of our favorites. And so what you're doing is you are foregoing that benefit today. You're not going to get any benefit when you put the money in there because you've already paid taxes on it. But the major benefit is that's going to continue to grow. And then one day when you go to pull on those funds, you're not going to have to pay taxes on the principal or the gains. These also aren't subject to RMDs, which is another big benefit. So the government
Right.
can't tell you when you need to take funds out.
And I know, Brent, that something that you specialize in at Young Wealth Management is controlling taxable earnings for your clients. What does that mean?
Correct. So very important. So by controlling how much taxable earnings you are taking in, you can use that for strategies in controlling healthcare costs.
Okay.
So a big one today is I want to retire early, but I'm not quite Medicare age. Is that even a possibility? Well, now that you can control that, depending on the accounts you have, you could get a good deal on healthcare costs. And that's something we've been working through a lot with lately.
That's great. Okay. Now, last question. As we talk this through, it's so obvious there are so many different retirement accounts to choose from then. So how do I figure out the right combination for me when it comes to tax diversification?
Sure. That's a great question. And it's one where you really need to be working with a financial advisor because there is no cookie cutter answer. Okay. It's going to be dependent on things like net worth, income, and then you can work with an advisor to figure out the best solution for you. But all three can be utilized and they're all great ways to save for retirement.
Okay. Well, Brent, talking this through is very helpful. If somebody has questions about any of these taxes or the accounts or again, healthcare costs, what's the best way to reach you?
614-430-8383. We can get you on the calendar. And then you can also go to www.young-wm.com and get scheduled there.
All right, Brent, thank you.
Thank you.